What if your money could make you money without you lifting a finger? That's the beauty of dividend investing. In 2025, it's easier than ever to build a solid portfolio that generates reliable passive income. Dividends are cash payments companies make to their shareholders from profits. When a company does well and makes money, it shares some of that success with you, typically paid out quarterly. It's like getting paid just for owning stock. Dividend investing allows you to earn money without worrying about the daily fluctuations of the stock market. It's a steady source of income, even when everything else feels uncertain. Dividends are generally paid by well-established companies with a track record of stability, which makes them an attractive option for building wealth over time. The money you receive can be reinvested, saved, or used however you choose. As inflation rises and interest rates remain high, dividend investing remains one of the most reliable ways to generate passive income. If you're tired of just saving and want to start earning through your investments, this video is for you. Stick around to find out exactly how to build a large dividend portfolio in 2025. 1. Clarify your investment objectives. Before you dive in, you need to figure out what you want your portfolio to do for you. Are you looking for immediate income, or are you building wealth over the long term? If your goal is to get cash in hand quickly, you might lean toward higher yield dividend stocks that pay out more now. Companies like AT&T or Verizon, known for their relatively high dividend yields, could be great options if immediate cash flow is your priority. But if you're more focused on building wealth over time and don't mind waiting a bit longer for higher returns, dividend growth stocks are the way to go. These stocks may start with a smaller payout, but over time, they increase their dividends as the company grows. Think of stocks like Johnson & Johnson or Microsoft. They're not just paying you dividends today, they're setting you up for bigger payouts in the future. 2. Achieve sectoral diversification. Don't make the mistake of putting all your money into one sector or industry. To create a resilient portfolio, diversification is key. Spread your investments across various sectors, such as healthcare, technology, utilities, and consumer goods. By diversifying, you're reducing risk. If one sector falters, the others can help offset the losses. For instance, healthcare stocks like Johnson & Johnson or Merck are strong choices for stability. In the utilities sector, Duke Energy and NextEra Energy have proven reliable dividend payers. Consumer goods companies like Procter & Gamble or Coca-Cola are known for their ability to weather economic downturns and continue paying consistent dividends. By balancing your investments across different industries, you're giving your portfolio the best chance to succeed no matter what the market throws at you. 3. Assess dividend sustainability. One of the biggest mistakes you can make is investing in a company that's paying out unsustainable dividends. A high dividend yield might look appealing, but if a company is paying out more than it can afford, you could be at risk of those payments disappearing down the line. The key is to focus on sustainability. Check out the company's payout ratio, which is the percentage of its earnings that's paid out as dividends. A ratio that's too high might signal that the company isn't keeping enough profit to reinvest in its business. A ratio between 40% and 60% is typically ideal. This means the company is paying out a reasonable portion of its profits while still leaving room for growth. Another sign of a sustainable dividend is a company's history. If the company has consistently paid and even increased its dividends over several years, that's a good indicator of a solid investment. Companies like Coca-Cola, McDonald's, and Pepsi have been paying dividends for decades, even in tough times. That's the kind of stability you want in your portfolio. 4. Reinvest dividends strategically. You don't have to cash out your dividends every time you receive a payment. One of the most powerful ways to grow your wealth through dividends is by reinvesting them. A dividend reinvestment plan, DRIP, allows you to automatically reinvest the dividends you earn into more shares of the stock. Over time, this builds compounding growth. Even if you start small, reinvesting your dividends means that your returns will start to snowball. Let's say you invest $10,000 in a stock with a 5% yield. At the end of the year, you'll earn $500 in dividends. If you reinvest that $500, your next year's dividends will be calculated on the new, larger amount. This compounding effect is one of the most effective ways to build wealth with dividends. If you're not interested in dealing with the reinvestment process manually, many brokers offer automatic DRIPS, which will reinvest your dividends for you without you having to lift a finger. It's an effortless way to watch your money grow. Spotlight on top dividend stocks for 2025. So which stocks are worth considering in 2025? When building a dividend portfolio, you want to focus on companies with solid fundamentals and a track record of reliable payouts. While I won't recommend specific stocks here, the key is to find companies that meet certain criteria: a strong history of paying and growing dividends, a sustainable payout ratio, and a solid business model. For example, in the healthcare sector, you'll find companies that provide critical products and services, ensuring steady demand. In the utilities sector, the need for energy and water ensures that companies in this space remain profitable even in tough times. Consumer goods companies, like those producing household items, are known for their stability and ability to maintain dividends even during recessions. Take the time to research each company's dividend history and ensure they align with your investment goals. As you gain more experience, you'll be able to spot the companies that fit your strategy and offer the most potential for long-term growth. Regular portfolio evaluation. Your work doesn't stop once you've built your dividend portfolio. It's important to regularly evaluate your investments to ensure they're performing as expected. You don't need to check your portfolio every day, but every few months, take a look at your holdings and see how they're doing. Are your dividend payouts increasing? Are any of your stocks in danger of cutting their dividends? It's essential to monitor how well your investments align with your long-term goals. If a stock isn't performing well, or if its dividends are decreasing, it may be time to swap it out for something stronger. You're in control of your portfolio, so make sure it's working for you. This might mean trimming underperforming stocks and adding new ones with better growth potential. Keep your portfolio dynamic and ready to adapt to changing market conditions. Embracing financial independence. As time goes by, your dividend portfolio grows and matures. Those regular dividend payments start to add up, creating a steady stream of income. You're not relying on a paycheck anymore. Your investments are working for you, giving you financial freedom. This is the beauty of dividend investing. It's not about getting rich quick, but about building wealth slowly and steadily. Over time, you'll see how those small, regular dividend payments can snowball into something much bigger. It's the kind of wealth that lasts, and it's the kind of wealth that allows you to live life on your terms. Ready to start building your dividend portfolio? Don't wait, begin your journey today. Start by researching the stocks I mentioned or find others that fit your financial goals. If you enjoyed this video, don't forget to hit the like button, share it with others who could benefit, and leave a comment with any questions you might have. And if you haven't already, subscribe to the channel and hit the bell icon to stay updated with more great content. Let's make 2025 the year you take control of your financial future.